twice. That's how many times this warning signal has appeared in the entire history of the S&P 500. It just happened again, and most investors are completely in the dark. Here's what's really going on and what you need to be thinking about right now. Because the last two times this signal fired, the market never looked the same afterward. The S&P 500 is sitting near all-time highs right now. Valuations are stretched, sentiment is euphoric, and buried inside that strength, a rare technical and fundamental warning signal has just triggered for only the third time in market history. The first two occurrences, they preceded two of the most devastating drawdowns American investors have ever lived through. We're talking peak-to-trough losses that wiped out years of gains overnight. Motley Fool analysts flagged this signal, and the data is not subtle. Both prior instances were followed by S&P 500 corrections exceeding 40%. 40%. That's not a dip. That's a portfolio restructuring event. Right now, retail investors are sitting on significant unrealized gains. The question isn't whether this market is expensive, it's whether this specific signal has the same predictive power it carried in 1999 and 2007. Institutional money is quietly repositioning. Options market skew is shifting. The smart money isn't panicking, but it is paying attention. You should be too. But here's what nobody is saying about this yet, and this is the part that changes everything. Two occurrences is not a statistically significant sample size. Any analyst worth their salt will tell you that. But the conditions surrounding each occurrence are eerily consistent. Elevated PE multiples above 25x, a Fed pivot narrative in full swing, and retail participation at cycle highs. Sound familiar? Because that's exactly where we are in May 2025. The signal isn't just rare. The macro backdrop amplifying it is almost identical to both prior setups. That's the part the headlines are missing. First, review your concentration risk. If your portfolio is heavily weighted toward mega-cap tech, you may be carrying more single-sector exposure than you realize heading into a potential volatility event. Second, understand your hedge options. Protective puts, inverse ETFs, and increased cash positioning are all tools that historically minded investors examine during elevated signal environments. Not panic moves, strategic optionality. Third, know your time horizon. Investors with a 10-plus year runway have historically been rewarded for holding through signal-driven volatility. Investors near retirement face an asymmetric risk profile that warrants a completely different conversation. 3 occurrences of the same signal, 2 previous disasters. One question that matters most right now: what do you think this means for your portfolio? Drop it below because this conversation needs to happen. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.